Hey, this is Tim, licensed loan officer. Welcome to the channel. On this video, we're going to talk about what is a home equity line of credit, or people call it a HELOC. Thank you so much for watching. And I want to tell you a little bit about what this channel is about. This channel is all about first-time home buyers, budgeting, leveling up, investment products, having excellent credit, pretty much all types of topics financial related. If you like those type of topics, please, I'd love to have you subscribe to this channel. Now in this video, what we're going to talk about is HELOCs or lines of credit or home equity lines of credit. Everybody is asking for them, and very few people really know how they work and the pros and cons and the pitfalls and just how to qualify for one. Like, I have people asking me for them and they don't even qualify. So we'll get into all that, and I'm going to tell you everything you need to know about them. And I will put some timestamps on this video so you can hop around a little bit for the various topics. So let's get into it. Let's talk about it. All right, so I'm just going to have a Word document, and basically class is in session, okay? So I want to just go over, what is a home equity line of credit, or something else, they call it a HELOAN. And we'll just talk about these really quick. So a home equity line of credit, so home equity, I can't spell, here we go. EQU, equity line of credit. And then this one is called a home equity loan. Now, these are not as popular, okay? You can still find these home equity loans, but they're not very popular. Basically, they just work like a regular loan, okay? So you're just borrowing from your equity of your home, and you pick the term. Some are 30-year terms, that's right, 15-year, 10-year terms. And the main benefit of a HELOAN is that it's backed by your home. So by it being backed by your home, it has the lowest interest rate. But be careful, because if you don't make the payment, you can lose your home. And that's something you want to be careful for both of these. But they're backed by your home, and they have the lowest rates. And what's good about these is that a lot of these have fixed rates. Fixed rates, and it's just a fixed loan, okay? That's what's great about these home equity loans. Like I said, they're not that popular. Most of the time, you're going to probably get a home equity line of credit, and that's what we're going to talk about now. So a home equity line of credit is basically a line of credit, okay? Think of it almost like a credit card. So let's talk about how they work. So the way it works is that, you're going to, of course, apply, with a lender or bank. Now, a lot of mortgage companies don't have equity lines of credits, but some do. But every bank, every credit union would definitely have that. So you're going to apply. And then the way it works, so just so you know how it works, is that it is a, I lost it there. Let's go back here. It is a 30-year loan, okay? But there's a caveat to it. So it is a 30-year loan. It's 30 years. But the first 10 years, so the first 10 years is called the draw period, okay? The draw period. So what that means is let's just say you apply and you get approved, okay? You get approved for, let's just say, $60,000, okay? You get approved for $60,000. So that first 10 years is your draw period. So what that means is that first 10 years, you're basically using it. So you say you need 10,000. So now you pay the interest on the 10,000. Let's say you need 20,000. And then it is a variable rate. So it's a variable rate. And you only have to pay interest only. So the first 10 years, it's just interest only, okay? So you have to be careful with these. You have to be careful because when you're only paying interest, you're not really paying the principal. So the first 10 years, you're mainly just required to pay interest. After the 10 years over, whatever the rate is, it goes to a fixed rate, and you have 20 years to pay off principal and interest. So that's kind of how a home equity line of credit works. It's a little confusing to some people, but the best way I explain it is think of it like a credit card. A credit card, they open it up. You don't have to use it, but when you use it, you have a minimum payment. Of course, you want to pay more than the minimum payment. So that's how a home equity line of credit works. Now, what's very important is let's talk about how do you qualify, okay? How do you qualify? I cannot spell. How do you qualify, for either a home equity line of credit or a HELOAN? Now, this is very important because a lot of people want these, but they don't necessarily qualify. The first thing is you need good credit. And when I mean good credit, I mean a FICO of 680. Why is this always hopping around? 680 or above. Now, you can find a few lenders or local credit unions that might give it to you for a 660 FICO or above. But generally speaking, you're going to need good credit and a 680, okay? And that's kind of like the minimum, okay? They're not for people that have poor credit or looking to rebuild their credit or anything like that. They are considered a second mortgage. So this is important. A second mortgage. So what happens is that you have your first mortgage, which is, your home loan, which you probably don't want to refinance. You probably have a 2 or 3% rate, maybe a 4% rate, a low interest rate. You don't want to touch your first mortgage. So that's what these are for. You still want to use your equity, but you don't want to tap into you don't want to refinance your first mortgage. So by it being in second place, it means your first mortgage with your low interest rate will get paid first. This is like, God forbid you foreclose or God forbid you stop making your payment. And then after that paid, then the remaining money goes towards any second liens. Now, it's important to note, if you already have a second mortgage, like solar panels, if you use a down payment assistant when you bought your home, or if you have a new roof that you're making payments on, a window, any kind of or you did a loan modification, or you did a forbearance during COVID, and they put some money on the back end. If you do any kind of home equity loan or home equity line of credit, that will have to be paid off. So it's very important you know that. So if you have $20,000 on your back end of your mortgage and you open up a line of credit, you're going to automatically have that included. So you already had a balance of $20,000. Lenders will not be in third place, okay? So let me just kind of explain it to you, because a lot of people don't understand how this works. They go, I don't want to pay that off. So you have your first mortgage. When you bought the home, let's just say that's a 3%. And then you have your second mortgage. Let's just say it's I don't know, 9%. Then you have your second mortgage. It could be like a 9%, something like that. Normally, the bulk of your money, like $200K, will be on your first mortgage, and then you have a second mortgage for like 60. That's normally how that would work for you. So let's just finish up the requirements here, since that's what we're talking about. So good credit. Second thing you're gonna need is 2 years of work history that they can verify. Work history would be your employment. 2 years of work history. And then no mortgage late in the last 12 months. People forget about that. You got to have good payment history to get a second mortgage. So good credit, 2-year work history, no mortgage late. And the last thing is very important. A lot of people miss this one, is debt to income. So debt to income has to be under 45%. What that means is all your minimum payments on your mortgage, not on your mortgage, but on your credit report, all the minimum payments plus your mortgage payment plus the potential payment of your second mortgage, whether it's a home equity line of credit or a HELOAN, has to be under 45%. If you're already over 45%, you can pay off debt. A lot of people use these home equity lines of credits to consolidate debt. And let's just we'll talk about rates in a second. They use them to usually consolidate debt because, credit cards are 25, 35, 30% interest rate, outrageous interest rates. And HELOC's interest rates are prime. They're prime plus margin. So you can look up the prime rate. If you go to Google, let's go to Google real quick here, and I'll show you the prime rate here. And this is good information. So if you like this stuff, please consider subscribing to this channel. I'm giving you a lot of knowledge and a lot of resources, educating you. And you don't need to call lenders and ask them the rate. I get that a lot too. A lot of people want to call lenders and want to know what's your rate. And lenders really don't know your rate because they don't have a credit report. They don't know your income. They don't know how much equity you have. But people call around and want to know rates. And I'll show you how to find out rates in a second here. So, what is the prime rate today? So the prime rate right now is 8.50. Okay, this is the prime rate right now. And the prime rate is set by the Federal Reserve. Okay. So what's going to happen is most of the time, if you get one today, let me see if I can. If you get one today, it's probably going to be the 8.5. That's the prime. Plus the bank got to make some money plus 2%. So you're probably looking at anywhere from anywhere from 10, to 15%. Now you may say that's high, but it's a second mortgage. Now a lot of banks have something called introductory rates. So if you shop around, a bank may give you a 6% rate for the first year or first 2 years. So shop around, compare. But be cautious because they're losing money if they give you a 6%. I've seen a lot of HELOCs or HELOANs at 6%, but eventually they have a way to get you up to that prime because they're losing money. But they will do that. Banks and lenders will lose money to get you in the door, so they have your email address, they can market to you. And what's very important to note too about home equity lines of credit and HELOANs is that people eventually, the main reason people open them is because they don't want to refinance or touch their first mortgage. However, after about 5-6 years, they get tired of making their mortgage payment on top of that equity line of credit payment, end up refinancing anyway. So they know that. And that's just historically. People want to refinance and roll it in, have one payment. So they may give you a 6%, 7%, 5%, whatever, but eventually that will end, and then you're looking at a little bit higher rate and higher payment. But the good news, you're only paying the higher interest rate on your second mortgage, not your full mortgage. And this video is getting long here. I want to show you how to find out the rate. So if you go to Google and you type in, rate table for home equity lines of credit. You just type that in there. And this is important because a lot of people call lenders and stuff like that. So we'll just go down here. And I think here we go, bank rate. Let's just click on that here. So if you click on that, and this is something you can do, and you would put in your zip code, because that plays a factor. You'll put in your property value, your estimate, what you think it is from Zillow. You'll put in your remaining balance, and then you would put in how much you want and then your credit score, and it will give you a rate. Now, you're not qualified. They still don't know your income and other things. And as you see here, it has home equity loan, and then HELOC, and then personal loan. Let's just click on, let's see, home equity loan. Let's just do HELOC. So just HELOC. So see, 7%. But remember, this is probably an introductory rate, 7%. So lenders will advertise low rates to get you in the door. And then eventually, see, the average is 9%. The average is 10%. And remember, if you have a little bit lower credit, it's going to be higher. So the average is 9%. You see, the average is 9%, but they're advertising 7% or 8%. Those are introductory or teaser rates. Get you in the door, give you that low rate for a year, and then it's going to go up. But remember, there's no prepaid penalties. You can always refinance it. And I just want to finish this video with some pros and cons. Okay, let's just finish this with some pros and cons. Okay, and I'll make this quick. One pro is you don't have to refinance. Okay, that's the biggest pro to these products. A con, not easy to qualify. Okay, it's not easy to qualify. Okay, most people can, but it's not easy to qualify. Okay, a pro, you only pay interest. You only pay interest on the money you use. That's a pro. A con, it's a second mortgage. Second mortgages mean that you have your first mortgage and your second mortgage. That's really all I can think of right now. This video is getting too long. It really is. All right. So I hope this explained a little bit for you. I hope this gave you a lot of different information and things like that. If you like this kind of content, please consider subscribing to this channel. I'd love to have you here. Thank you so much for watching, and I'll see you again in the next video. Thanks. Buddha.